American silver investors just watch their portfolios get destroyed in a matter of hours. If you are one of them, you already know the pain. If you are watching from the sidelines, you are wondering if this is finally your chance to buy. But here is what nobody is telling you. What happened? Friday, January 30th was just the beginning. Silver crashed 30% in a single day from $12,164 to $78 to $84. The crash set something in motion that will fully reveal itself when U.S. markets open Monday morning, February 2nd at 9:30 Eastern. I've been analyzing the data all weekend. The futures positioning, the CME margin hikes, the overseas reaction, the India catastrophe, the technical damage, and what I found has massive implications for every American holding silver right now. Monday's open could be a bloodbath continuation, or it could be the buying opportunity of the decade. The difference depends on factors that most investors do not even know exist. You need to see this before Wall Street opens. Welcome to my channel, Currency and Currency. I break down the financial moves that mainstream American media ignores or gets completely wrong. If this video helps you navigate Monday's chaos, smash that like button. Subscribe if you want to see what is coming before CNBC catches up. I spent my entire weekend analyzing what happened to silver on Friday, January 30th. While most Americans were enjoying their weekend, I was buried in charts, data, positioning reports, and margin requirement notices. But clear's throat. And what I found is deeply concerning. The crash was not random, the timing was not coincidental, and the implications for Monday's U.S. market open are significant. Whether you own physical silver, paper ETFs like SLV, mining stocks, or you have been waiting for a chance to buy, the next 48 hours matter more than you might realize. I'm going to break down exactly what caused the crash. What the CME did with margin requirements, what happened in overseas markets while America slept, including India's catastrophic sell-off, and what you need to watch for when the opening bell rings on Wall Street Monday morning. The January 30th crash. Let me walk you through exactly what happened to silver on Friday, January 30th, 2026, because the details matter. Thursday, January 29th was the peak. Silver hit an all-time record high of 121.64 per ounce. The white metal had been on an unprecedented 9-month winning streak. American investors holding silver had watched their positions gain over 170% from the previous year when silver was trading around $32 per ounce. Euphoria was everywhere. Financial media was calling silver the trade of the year. Retail investors were pouring into SLV and mining stocks. It felt unstoppable. Then Friday happened. The selling started before most American traders even had their morning coffee. It was not gradual. It was not orderly. It was a cascade. Massive sell orders hit the comics. Prices dropped through support level after support level. Stop losses triggered across thousands of accounts. Margin calls went out electronically. Forced liquidation accelerated the decline. By the time the dust settled, silver had crashed over 30% in a single day. Some intraday readings showed silver as low as $78 per ounce. By Friday's close, silver was around $84 per ounce. This was the worst single-day drop since March 1980, over 45 years ago. Billions of dollars in value evaporated. American retirement accounts holding precious metals got hit. Mining stocks in the S&P and Russell indexes collapsed even harder than silver itself, some down 40 to 50% in a single session. As of Sunday, February 1st, silver is trading around $85 to $86 in overnight markets. That is still up massively from $32 a year ago, but it is down catastrophically from Thursday's $12,164 high. The financial media gave you surface-level explanations, profit-taking, dollar strength, technical selling, the usual generic nonsense they always give, but that is not the real story. The real story is about positioning, about leverage, about margin hikes, about a market that was deliberately set up for exactly this kind of move. The real cause, the mainstream American financial media does not understand the silver market. They cover it like they cover stocks, supply and demand, earnings reports, analyst upgrades, but the silver market does not work that way. The silver market is dominated by the derivatives market, by futures and options traded on the COMEX in New York, by paper claims that vastly exceed physical supply. Here is what actually triggered the Friday crash. Catalyst number one was the Kevin Warsh Federal Reserve Chair nomination. On Friday morning, before markets opened, President Trump nominated Kevin Walsh as the next Federal Reserve Chairman. The market interpreted this as reducing the risk of extreme dollar weakness and Fed independence concerns. The dollar spiked. Gold fell 9%. Silver, being more volatile than gold, fell even harder. This was the match that lit the fuse, but the powder keg had already been prepared. Catalyst number two, the CME margin hikes, was the real killer. This is what mainstream media barely mentioned, and it is the most important part of the story. The CME group, which runs the COMEX, where American silver futures trade, raised margin requirements twice in the week leading up to the crash. On January 28th, Tuesday, the first margin hike increased silver margins from 9% to 11% of notional value for non-heightened risk profiles. Heightened risk profiles increased from 9.9% to 12.1%. This was announced as silver was hitting record highs. On January 31st, Friday, the second margin hike raised gold margins to 8% from 6%. Silver margins were raised again to ensure adequate collateral coverage. What this means in real dollars is critical to understand. Each KC silver futures contract represents 5,000 ounces of silver. At $120 per ounce, that is $600,000 of notional value. Before the margin hikes, a trader needed about $54,000 in margin per contract. After the hikes, that jumped to around $66,000 to $72,000 per contract. When margin requirements go up by $12,000 to $18,000 per contract, traders who are leveraged long suddenly need more cash in their accounts immediately. If they do not have that cash, they have two choices: deposit more money or get liquidated. Most do not have extra cash lying around, so the broker automatically sells their position. They do not have a choice: forced liquidation. Thousands of American traders got margin calls on Friday. They were forced to sell at the worst possible time during a crash. Their selling triggered more selling. More margin calls went out. The cascade fed on itself. This is the same playbook we saw in 1980 when silver crashed from $50 and margin hikes killed the rally. In 2011, when silver crashed from 49p82 and margin hikes crushed leverage longs. In December 2025, when silver first approached 90 and margin hikes caused a 15% correction, clears throat, raise margins, trigger liquidation, crash prices. It works every single time, and the CME just did it again. Catalyst number 3 was the positioning extreme. Before the crash, the Commitment of Traders report showed that speculative long positions had reached extreme levels. Too many American retail traders on one side of the trade. Everyone was bullish. When everyone is bullish and leveraged, there is no one left to buy. The only direction is down. Large commercial traders, which are banks and institutions, knew this. They saw the margin hikes coming. They positioned accordingly. Catalyst number 4 was the technical level. Silver had hit 12,164, a resistance level that traders had been watching for years. When silver could not break decisively above and hold those levels, technical traders started selling. Combined with the margin hikes and the WRS nomination, the technical failure triggered algorithmic selling that accelerated the crash. This crash was not random, it was engineered. And understanding that helps you understand what comes next on Monday. What happened overseas? Now, let me tell you what happened in Asian and European markets over the weekend while American investors were sleeping, because this is critical context for Monday's open. India's catastrophic collapse happened Sunday, February 1st. While Americans were enjoying their weekend, India's silver market experienced a bloodbath. MCX silver February 2026. Futures crashed as low as 2,91,952 rupees per kilogram, approximately $97 per ounce equivalent. This represented a plunge of 45,000 rupees per kilogram in a single session, an 11 to 15% drop. Chennai saw prices drop 85,000 rupees per kilogram. Mumbai, Delhi, Kolkata. Uniform panic selling across every major Indian hub. Why did India crash so hard? 3 factors. First, intense profit-taking after silver's surge to all-time highs of 4.1 lakh rupees per kilogram just 3 days earlier. Second, hawkish global cues surrounding the WRS chair nomination. Third, extreme investor caution ahead of India's Union Budget 2026 presentation. Why this matters for Monday's American Open is absolutely critical. India is one of the world's largest physical silver markets. Indian buying has historically provided support during Western sell-offs. When Indian buyers panic sell instead of buying dips, it signals global physical demand stress. The selling pressure from India over the weekend creates a negative sentiment backdrop heading into Monday's U.S. session. If the Sunday India sell-off spreads to Shanghai and Hong Kong overnight, the U.S. market could gap down significantly at Monday's open. The Shanghai and Hong Kong reaction is still developing. Asian markets that trade Sunday evening, Monday morning, U.S. time will set the tone. Early indications from futures markets suggest volatility, but no clear direction yet. Physical silver premiums in China have shown mixed signals. Some reports suggest Chinese buyers are stepping in at lower prices. Other reports suggest selling pressure continues. This divergence between paper and physical is important. It suggests that institutional demand for actual metal may remain strong even as the paper market crashes. The London positioning will provide additional data points when it opens Monday morning before New York. European institutions are divided. Some see the crash as a buying opportunity. Others see it as the start of prolonged decline. LBMA inventories will be closely watched. If physical metal is being withdrawn from London vaults despite lower prices, it signals strong real demand. Silver futures overnight action. Sunday into Monday is showing volatile price action between $82 and $88. Attempts to rally are being met with selling. Attempts to crash further are being met with buying. A battle is underway between bulls and bears. The overnight to Sunday action will tell American traders everything they need to know about Monday's likely open. If Asia stabilizes silver above 85, Monday could see recovery. If Asia pushes silver below 82, Monday could see continued carnage. The technical damage. Let me show you the technical damage from Friday's crash and what it means for Monday. Silver crashed through multiple critical support levels on Friday. 110, 100, 95, 90, all violated. 85 is barely holding. These levels represented areas where buyers had previously stepped in aggressively. Breaking them all in one day suggests those buyers were overwhelmed or gave up entirely. The question for Monday is whether silver can reclaim any of these broken levels. If it does, Friday was a shakeout and prices could recover quickly. If not, these former supports become resistance and more downside is likely. Silver also sliced through its 20-day, 50-day, 100-day, and 200-day moving averages. All major moving averages are now above current price, a bearish configuration. For the trend to remain bullish, silver needs to quickly reclaim these averages. Friday's crash happened on massive volume, the highest in years. High volume on a down day typically shows conviction behind the selling. However, capitulation bottoms also happen on high volume. When the last sellers finally panic and give up, Monday's price action will reveal which this was. High volume buying suggests Friday was capitulation. High volume selling suggests more downside. Low volume chop suggests uncertainty. The weekly candle that printed Friday is one of the ugliest in silver's history, or snorts, a massive 30% red candle closing near its lows. This often leads to follow-through selling. However, extreme weekly candles can also mark turning points like the 1987 stock crash or 2020 COVID crash. Monday's action will either confirm this bearish pattern or start to negate it. The comics delivery situation. Here is something mainstream media is not telling you that American silver investors desperately need to understand. COMEX inventories are at crisis levels. As of late January 2026, total COMEX silver inventory sits at approximately 440 million ounces. But registered inventory, which is available for actual delivery, is only 124 million ounces, just 28% of total. Recent withdrawals show 33.45 million ounces physically withdrawn in just 7 days in early January. That means roughly 26% of deliverable silver disappeared from COMEX in 1 week. The March 2026 contract pressure is building. The March silver futures contract has open interest representing over 500 million ounces of silver. There are only 124 million ounces registered and available for delivery. That is a 4.1 paper to physical ratio just in the March contract alone. The system only works if most traders settle in cash or roll their contracts forward. If they demand physical delivery, the math breaks down fast. The first notice day is February 27th. On February 27th, traders holding March futures contracts can start demanding physical delivery. This is when we will find out if the COMEX has enough metal to meet delivery requests. If delivery demands exceed available supply, we could see force majeure declarations, cash settlements instead of physical delivery, a complete breakdown of the paper pricing mechanism, or violent upside price moves in physical silver. This is why Monday matters so much. The crash may have triggered some physical demand as traders take advantage of lower paper prices to secure actual metal. If physical deliveries spike while registered inventory remains depleted, it could trigger the squeeze that silver bulls have been predicting. China's export controls. Here's another factor that American investors need to understand heading into Monday. China controls 60 to 70% of global refined silver supply. China officially classified silver as a strategic material and implemented export controls starting January 1st, 2026. These controls restrict overseas sales to large, state-certified producers. This fragments the global silver market into regional islands. Asia, primarily China, and India is controlled by China's export licensing. North America, centered on COMEX, is facing inventory depletion. Europe, centered on LBMA, is caught in the middle. The decoupling is real. Before China's export controls, silver flowed freely around the world to wherever prices were highest. Now that flow is restricted. American industrial users who need silver for solar panels, electric vehicles, and electronics cannot easily access Chinese supply. They have to bid for metal on COMEX or from other sources. This creates structural support for American silver prices. Even as the paper market crashes, industrial users do not care if silver crashed from 121 to 84. They still need the metal. They will pay what is necessary to secure supply. Monday's wildcard scenario involves China. If China announces additional tightening of export restrictions over the weekend, or if reports emerge of American industrial buyers scrambling to secure supply at crashed prices, Monday could see a sharp reversal despite the bearish sentiment. Watch for any China-related news Sunday evening, Monday morning. It could completely change the Monday opening dynamic. Monday scenarios. Let me walk you through the specific scenarios for Monday's U.S. market open on February 2nd, 2026. Scenario 1, continuation crash, 20% probability. Silver gaps down to 78 to 80 or lower. Overnight, Asia and India selling continued. 1930 open sees immediate additional selling. Prices drop another 5 to 10%. More margin calls. By day end, silver tests 70 to 75. Mining stocks collapse another 20 to 30%. This happens if Asia sells aggressively, CME announces further margin increases, physical premiums collapse, and no buyers step in. Hold physical, consider accumulating at generational lows. Scenario 2, dead cat bounce failure, 30% probability. Silver opens slightly higher at 87 to 90. Bargain hunters step in. Looks like the worst is over, but rally fails. By midday, sellers return. Broken 95 support now acts as resistance. By close, silver is flat or slightly lower at 82 to 84. Neither bulls nor bears win. This happens if Asia shows mixed signals. Some buyers step in but insufficient to sustain rallies, and traders wait for Friday's jobs report. Reduce overexposure, do not chase. Wait for clarity. Scenario 3, V-shaped recovery, 35% probability. Silver opens higher at 88 to 92 and accelerates all day, closing above 95 to 100. Buyers aggressively step in. Physical buyers recognize the gift. Short sellers cover nervously. Silver reclaims broken 95 support. Narrative shifts from crash to correction and opportunity. This happens if Asia shows strong buying, especially from China. Physical premiums stay elevated. Institutions deploy cash. And Friday's crash is recognized as margin-induced, not fundamental. Act quickly if waiting to buy. Scenario 4, gap and reverse shakeout. 15% probability. Silver gaps down to 78 to 80. Panic selling resumes. Headlines scream crash, weak hands capitulate. Then something shifts, mid and morning. Whale buyer steps in, or physical deliveries spike, or China announces support. Prices reverse violently. Short sellers squeezed. By close, silver ends 88 to 95, well above opening. This happens if large players trigger stops to accumulate. Physical tightness becomes undeniable. Gap exhausts sellers and strong hands buy aggressively. What American investors should do? Let me give specific guidance for American investors based on how you are positioned heading into Monday. If you own physical silver bullion, like coins, bars, and rounds, you are in the safest position of any silver holder. Your metal cannot be marginal called, cannot be taken from you by a broker, cannot be affected by COMEX shenanigans. My suggestion is to do nothing with your existing position based on Monday's price action alone. Physical silver is a long-term strategic hold. Friday's crash hurt on paper, but you're still up massively from a year ago. However, watch Monday's action for potential adding opportunities. If we get scenario 1 or 4 with gaps down to 75 to 80, you might be able to add to your physical stack at prices you will never see again. Do not let emotions drive decisions. If you bought silver as insurance against monetary system failure, that thesis has not changed. Hold. If you own SLV or other silver ETFs, your position gapped down Friday and will gap again Monday when markets open. You will not have a chance to react to overnight moves. You will open Monday already up or down from Friday's close. My suggestion is to decide right now before Asia opens Sunday evening what you will do in each Monday scenario. If SLV gaps down 10% at the open, will you sell, hold, or buy more? If SLV gaps up 5% at the open, will you sell into strength, hold, or buy more? Make these decisions now while you are calm and rational. Write them down if you have to. Then execute your plan Monday, regardless of how you feel emotionally. If you are overweight, silver ETFs relative to your risk tolerance, and Friday has crash made you physically sick, consider reducing position size into any Monday strength. This level of volatility is not for everyone. If you own American silver mining stocks like First Majestic, Hecla, or Pan American Silver, your stocks were devastated Friday. Many miners fell 40 to 50% in a single day. They will be even more volatile than silver itself on Monday. My suggestion is to review your position sizes immediately. Are you comfortable with a potential 30 to 40% move in either direction on Monday? If not, you're overexposed. Consider which miners you own. Quality miners with strong balance sheets, low debt, and profitable operations will survive and eventually recover. Marginal miners with high debt, unprofitable operations, and poor management could go bankrupt if silver stays depressed. If you own low-quality names, Monday might be your last chance to exit before bankruptcy becomes real. If you own high-quality names and have conviction in the long-term silver thesis, Friday's crash created historic buying opportunities. If you are considering buying the dip, Friday's crash might look like the opportunity of a lifetime. And it might be, but buying a falling knife is extremely dangerous. My suggestion is to not rush in Monday morning at the open. Let the first 30 to 60 minutes of trading reveal the market's intentions. If we are getting scenario 3 with recovery rally, you can still buy later Monday and catch most of the move. If we are getting scenario 1 with continuation crash, you will be glad you waited. Scale in rather than going Allen by 25% of your intended position Monday. If it drops more, buy another 25%. Average down rather than trying to pick the exact bottom. If you are buying the dip, strongly consider buying physical metal rather than ETFs or mining stocks. The disconnect between paper and physical could widen dramatically if COMEX has delivery issues. If you're leveraged or trading on margin, this section is specifically for American traders using COMEX silver futures contracts or margin accounts to trade silver. My critical suggestion is to close or drastically reduce leverage positions before Asia opens Sunday evening if you have not already. Friday proved that 30% moves can happen in one day. The CME proved they will raise margins at the worst possible time. Being right about long-term direction means absolutely nothing if you get liquidated on Monday morning. If you cannot close positions before Sunday's Asia Open, at least have a plan. Where is your pain threshold? At what price will you voluntarily exit to avoid forced liquidation? Do you have additional cash to meet potential margin calls? Do not make emotional real-time decisions. Monday morning during fast market conditions. Have your exit levels programmed in advance. If you have cash and are watching from the sidelines, you are in the best position of all. You have optionality. You can act when you choose. You're not bleeding value every hour silver drops. My suggestion is to be patient. Do not feel like you have to act Monday. The market will give you opportunities. If Friday was capitulation with scenario 3, silver will recover with or without you. You might miss the exact bottom, but you can still participate in the recovery. If Friday was just the beginning with scenario 1, you'll get much better prices later this week or next week. Let Monday's price, action, and volume give you information. Then make informed decisions Tuesday or Wednesday when you have more clarity, the bigger picture. Let me zoom out and explain why this crash matters for American investors beyond just price. Many Americans bought silver as protection against inflation and dollar debasement. With U.S. inflation elevated, national debt exceeding $36 trillion, and the Fed in a difficult position, the thesis made sense. Friday's crash does not change the fundamental picture. The government runs massive deficits. The dollar is being printed at unprecedented rates. Real inflation destroys purchasing power and the monetary system is fragile. But the crash raises questions about silver's short-term reliability. If it can crash 30% in a day, is it safe? The answer, silver has never been stable. It is volatile, always has been. 1980, 2011, and now 2026 prove this. Silver is not a short-term safe haven. It is a long-term strategic asset. The inflation hedge thesis remains intact for patient holders. But short-term volatility is the price of admission. American companies are investing hundreds of billions in solar, electric vehicles, AI data centers, 5G, and defense electronics all require silver. This industrial demand is structural, not cyclical. The crash does not change this. It makes silver cheaper for American industrial users. Their buying should provide support somewhere. The question is, where? 85, 75. Monday will provide clues. If COMEX cannot deliver physical silver to those who demand it, implications are severe. Best case, paper disconnects from physical and your physical silver becomes worth more. Worst case, COMEX collapses and takes the pricing mechanism with it. Most likely, COMEX forces cash settlements premium spike, but the market continues with reduced credibility. Monday through March 27th will reveal which scenario. Psychological preparation. Let me prepare you for Monday's emotional challenge. Because for many American investors, the psychological test will be harder than the financial one. If you held through Friday's crash, you are traumatized. Watching 30% evaporate in hours is violent trauma to your portfolio and psyche. You might feel fear about another crash, doubt about your decision, regret about not selling at 120, or paralysis about what to do. These feelings are normal but dangerous if they drive decisions. If you sold during Friday's crash, you're dealing with relief, regret, hope for lower prices to buy back, or fear that Monday recovers without you. These feelings can cause emotional reactive decisions. If you waited to buy and missed the rally, you might feel vindication, greed, thinking this is your chance, fear about catching a falling knife, or FOMO that you will miss it again. Whatever you feel, Monday morning is probably pushing you toward the wrong decision. Fear makes you sell at bottoms. Greed makes you buy at tops. Hope makes you hold losing positions too long. Regret makes you chase moves. The market transfers wealth from emotional investors to disciplined ones. The solution, make your decisions before Monday's open. Decide now at what price you would buy more, sell some, or do nothing. Write it down. Then, Monday, execute your predetermined plan. This is not easy, but it is the difference between surviving volatility and being destroyed by it. Friday, January 30th, 2026 will go down as one of the most violent days in silver history. A 30% crash. from all-time highs. Billions evaporated, thousands of American investors devastated. But context matters. March 1980, silver crashed from 50 to 10 over months, taking 30 plus years to exceed 50 again. 2011, silver crashed from 49.82 and did not sustainably exceed 25 until 2020, nearly a decade. March 2020, silver crashed from 18 to 12 during COVID, then doubled to 30 within months. Which parallel are we following? Monday will not answer this definitively, but it provides the first major clue. Despite Friday's crash, facts remain. Industrial demand hit records. Solar, EV, and AI demand grows exponentially. COMEX inventories critically depleted. China's export controls fragment supply. Supply deficits persist. Mine production cannot increase quickly. The paper price crashed 30%. The physical shortage did not disappear. This creates either a historic buying opportunity if fundamentals overwhelm technical damage, or a value trap if technical damage permanently changes market structure. Are you a trader or investor? Traders care about Monday's gap and short-term moves. Investors care about 2027 through 2035 and use crashes to accumulate. Both are valid, but you need to know which you are because they require completely different Monday actions. Survivors will be those who managed risk before the crash, have a Monday plan, understand their time frame, and control emotions. Non-S survivors were over-leveraged, make emotional Monday decisions, chase moves without plans, and let volatility destroy conviction. Which will you be? The weekend is almost over. Monday's coming. Make your choices while you have time. If this video helped you prepare for Monday, February 2nd, hit that like button right now. One click helps other American silver investors find this critical information before markets open. Share this video immediately. Text the link to anyone you know who owns silver. They need to see this before the opening bell rings Monday morning at 9:30 a.m. Eastern. Subscribe and turn on all notifications. Monday will be volatile. I may post real-time updates during trading. You want to see those alerts immediately. Drop a comment telling me your plan for Monday. What are you doing at the open? Buying the dip, selling the rip, holding tight, reducing exposure. I read every single comment, and I want to know how fellow American investors are navigating this. The crash happened. That is done. Now we deal with what comes next. See you on the other side, America. Stay sharp. Stay disciplined.